us now, Managing Director and co-head with Kotak Institutional Equities. Sanjeev, good morning. Thank you for joining us. You set cat amongst the pigeon when 2 weeks ago Kotak came out with the release saying that we are officially stopping coverage in mid-cap stocks. What prompted you to come up with a report like this? I mean, it's a powerful statement, right?
No, first of all, big clarification, we have not stopped coverage of mid-cap stock. I don't know how that thing started. We have only dropped the model portfolio which I used to run, which most people wouldn't even have bothered with, to be honest with you. So I don't know what was the big hangama around, us dropping a 15 stock model portfolio. I don't know. If we continue to cover several mid-cap stocks, in fact, all the mid-cap stock which we used to cover, everything is still under coverage. So
that you stopped the model portfolio. What does that mean?
Right. Well, as we have written the report, so many stocks run up so much in the past few months. Whatever stocks we had in the model portfolio, in most cases, the stocks were trading higher than our fair values. So obviously, it becomes very, irresponsible for a strategist or anybody to be recommending stocks where the fair value is lower than the current market price. So the option was to, remove all the names where we were seeing this problem, in which case would have been left with only some financial names. So I thought the better thing is, instead of having a portfolio which covers only mid-cap, banks and NBFCs, why just remove the entire thing? That's what we did.
In September, another report which says defensive stocks, no defense against any potential negatives. So I'll let you interpret this report. What do you mean by this report, 16 September?
If you look at the reverse valuation exercise we have done, the kind of revenue numbers being implied in the short term by based on the current stock prices look fairly unachievable, I would say. So for the 8-9 stocks which we are looked at, which has did a reverse valuation exercise. So if, let's say the current market price and current market cap is this much, these companies will have to have a certain amount of that to justify the current market cap. And based on that we need a certain amount of revenues to justify the current market cap. The numbers which are being thrown up suggest that the revenue number should be about 2 times what this company delivered in FY23. So that is not going to happen in a short time frame of 1 to 2 years, right? So that's the point we're making, even though we are quite positive on the longer term story of more spending by the government on defense capex, more international taking place. We should all be positive for defense stock, but a lot of good news and more is actually getting priced in. So that's a limited point we're making out in many of these reports that we have been putting out, that we are not comfortable with the valuations.
At large also, Sanjeev, do you believe that the mid and the small cap end of the market may be getting a bit more frothy, and it may make sense to take chips off the table pretty much across the board if you are in the market for a slightly medium to short term kind of time frame, and maybe deploy that into the large caps?
If you look at most of the mid caps, small caps particularly, anything to do with the investment piece of the economy, whether it is capital goods or defense or renewables, railways, etc. They have all run up a lot in the last few months. I mean, you look at the stock charts, you will start wondering, what has happened, what has changed so dramatically for the stocks. Yes, obviously there have been some positive developments, and we are quite positive on the investment cycle going forward. But to justify, 100%, 12% moves in stocks in 6 months, that's impossible, right? I mean, what has changed fundamentally in some of the stocks to justify a 12% move in some of the stocks? So that's a limited point over here. They're just struggling to figure out the reasons as to why the stocks have gone up so much, when at least the stocks recover, the fundamentals haven't really changed that much. So in most cases, the stocks are looking very, very expensive. They're all factoring a lot of positive news. And if you do any sensible reverse valuation exercise, in many cases, the implied volume numbers, profitability numbers, revenue numbers are completely out of whack, compared to whatever is possible in the next, let's say, 2 to 3 years. So my best sense here would be that many of the stocks could either price correct whenever that happens. Impossible to forecast, when the market mood changes, or it's possible that many of the stocks could just go through a long period of time correction, and we have seen that. Right? Look at many of the stocks from 2007, 2008 bubble period. It took 7-8 years, so many stocks will go back to the same level. You look at the mid mid-caps in 2017-18, again, you had this period of excess euphoria in the market at that time. Many of the mid-caps struggled for the next 5 years after that. Again, we are seeing a period where, expectations have run, well ahead of the fundamentals. So my best sense here would be, either the stock price correct whenever they do. I'm not going to forecast all this stuff here. I have no expertise to forecast stock prices. Or, they will time correct over a period of time.
So, given this market construct that you just painted, Sanjeev, is there value anywhere on the table right now across the board and across market caps?
It's largely in the financial sector. So whether you look at the large cap banks, mid-cap banks and BFCs or small caps, that's the only place where we see some value. Otherwise, consumption names are still very expensive. And the underlying environment for consumption is actually very, very weak. You have seen the numbers and the commentary from companies over the last 3 quarters. I mean, really there is a struggle as far as consumption is concerned. When you look at our own GDP numbers now, 1Q FY24 versus 1Q FY20, 4 year CAGR for private consumption is 3.5%. So clearly there is a challenge in the economy as far as consumption growth is concerned. And same way when I look at the investment part piece, that all the stuff which falls on investment, everything is looking so expensive over there. As I said earlier, we are very positive on the investment cycle, but the way the stocks run up, it's just very hard to justify the valuations, based on the fundamentals what we are seeing for the time being. Same way if I look at the outsourcing names, maybe you can make some case for some of the IT names, some of the pharma names. They're probably, slightly ahead of fundamentals. But beyond, I would say, financials and some of the outsourcing names, they're just struggling for ideas at this point in time.
Okay. So there are two...
Okay, sorry, 1 second. I think you guys need to correct that header over there, stoppage coverage on stocks and all that stuff.
We've got... So the flash which is going on... The flash which is going on is actually what you just said, and I'm glad we're having a chat around this, that stop coverage on stocks where valuations are expensive. I think that's the perfect messaging, right?
No, we have not stopped coverage here. Who is saying we have stopped coverage? We have coverage of stocks, we are maintaining ratings. So what is this thing about stopping coverage?
Continue to cover several mid-cap stocks. It's only model portfolio where the stocks were expensive. You've not continued the model portfolio.
The model portfolio is just something which you recommend to investors. That's it. So we have dropped the model portfolio, but we're not covering the stocks here. Just to clarify, once and for heaven's sake, man, don't get me into trouble.
Get that flash right, and I will send you a WhatsApp message after that. Don't worry. Don't worry. We don't want to. I'm glad we're having this chat. At least this clarifies. That report, by the way, actually attracted a lot of attention. And more than media attention.
I don't want to get in trouble with the Indian people here.
No. Don't worry about that. Okay. So let's understand what should be the best strategy in this kind of a market. Now, whether it's defense or railways or power, the level of participation has been strong. So for those who own these stocks and who can digest a 20-25% volatility, should they call them as mega trends and stick to them for next 3-5 years?
Well, you can stick to them, but you're probably not going to make a lot of money given the way the valuations are run up. So they are pricing a lot of growth. That's a problem. A lot of growth for the next 3-4 years is probably already priced in. So how do you make money in that case here? So you see that what would happen is even the earnings will come through, volume growth will come through, revenues will come through. I'm not debating on that. You will see growth in most sectors in the country. But you will probably see multiples coming down at the same time, which means your stock returns may be very, very muted going forward. I mean, it's a simple, fact of valuations here. Valuation high, the chances of making money is probably low. Everything else remaining the same. So there's no rocket science we are trying to, explain over here.
One sector which we distinctly discussed last time was autos, and you were not comfortable with valuations in autos. And now mixed picture seems to be coming out. Well, auto companies are saying inventory built up is largely because of the pre-festival demand. Frankly, the ground evidence seems to be indicating that demand is not as strong as what it was, let's say, 6-8 months ago. So you don't think somewhere markets will be in for some rude shockers post this entire festival season when it comes to autos?
Well, I hope the festival season really results in demand picking up, because everybody is sort of waiting for that, because the narrative has shifted from recovery in the March quarter to the June quarter, then good monsoons, which unfortunately haven't really played out, now to the festive season. And then maybe to the election spending and whatnot, So I just hope the festival season, really results in or shows a big pickup in demand. Otherwise, the stocks could actually see a big correction. See, the stocks are run up a lot in anticipation of volume recovery, which is still not taking place, at least based on whatever data we are seeing till August. And even if you look at September retail data, which comes out every day, you can track that on the government side. It's again not really showing any real pickup in volumes over there. So underlying retail demand still is fairly muted, and this is true pretty much across the board, I would say. And the other reason why the stocks went up was a big improvement in profitability starting from 3Q of FY23. That's a December 2022 quarter because of the decline in commodity prices. Since then, obviously, oil prices have gone up, even though they were not having any impact on the cost of ownership for Indian households, given the fact that you're not seeing any change in diesel or petrol prices. But yeah, we're starting slowly but surely, starting to see some increase in again budget prices, and given the fact rupee depreciating in rupee terms again, the raw material prices are starting to move up once again. So the worry over here is if volumes don't pick up and profitability or gross margins, EBITDA margins start coming under pressure, how does the market react to that? Because currently a lot of good news and probably more is getting priced in terms of volume recovery and very high, EBITDA margin, which we have seen in the 1Q FY24, that's sustaining for the rest of the year and beyond.
All right, Sanjeev, good to have you on board. Thanks so much for joining in, clarifying those details, and of course, sharing with us your view on the markets. Just a quick check-in as to what the index